Here on The Quality Investor, we only deal with top-rated businesses. And one of the absolute best just released their Q2 2025 earnings. This business posted steady, reliable growth yet again on both the top and bottom line. But this growing business had another sell-off in the market, falling over 8% the day earnings were released. Are MSCI's best days behind it? Or is this market acting irrationally with this indexing giant? Welcome to The Quality Investor. This earnings report was by no means extraordinary or even great. It was merely good. However, it did underscore the strength of MSCI's business model yet again. There was nothing that should sound alarm bells for investors to panic sell. But panic sell is what some investors did anyways. And while the share price has seen some recovery, we'll get into the primary reason for the fall in share price. What MSCI showed in the earnings report is its sustainable economic moat. Margins, an effective quantitative indicator of moat strength, continue to rise, as has their return on invested capital. Their moat is driven by strong switching costs and a network effect. Clients face significant barriers to switching providers because MSCI's tools and indexes are mission critical for investment decisions, portfolio benchmarking, and performance tracking. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Asset managers and ETFs built around MSCI indexes would incur high costs in retooling, renegotiating contracts, and retraining staff if they switched. This stickiness supports strong retention rates around 94 to 95% and pricing power, allowing MSCI to raise fees annually without much churn. As for their network effect, the more funds benchmarked to MSCI indexes, the more valuable they become as an industry standard. This cycle reinforces itself. Greater adoption attracts more users, reinforcing MSCI's dominance. For instance, MSCI captured a significant share of ETF inflows, and its indexes are embedded in the global financial ecosystem, making it nearly irreplaceable for many institutions. I mentioned retention rates, and really, that seems to be the main reason for MSCI's drop. This tweet illustrates what I believe is the reason for the fall that we saw for MSCI in the market last week. MSCI had a horrible quarter, with segment retention rate falling quarter over quarter across every segment. And it is true for the June 2025 quarter. For the index segment, we saw the retention rate go from 96.5% to 96%, a negative 0.5% drop, a negative 1.8% drop in analytics, and so on, and even a negative 0.7% drop for the sustainability and climate segment, one of the segments expected to grow very fast for MSCI. It's hard to know if he's being facetious with this tweet, but year over year, the index retention rate actually grew 0.8%. 95.2 up to 96. And you can see it's kind of choppy each quarter here. What retention rate is describing is MSCI's stability and durability of their recurring revenue base. MSCI has a subscription-based business model. That is one thing that makes them such a great business, is measuring the percentage of the prior period's subscription run rate that is retained once you account for client cancellations. There's an interesting thread by David Perlmutter, which I linked in the description below, that describes MSCI's quarter pretty well. And in one of the tweets in this thread, it says, one of the most beautiful things about MSCI, their business model, is that most of it is subscription-based. Couple that with the fact that it is a worldwide in scope with an essentially infinite runway, and we can understand why it has been able to grow so steadily over the years. I've talked about that a lot. But when a business reports what looks like a slowdown in subscription growth, investors and traders alike can freak out. It also didn't help matters when they reported the subscription retention rate falling from 95.3% last quarter to 94.4% this quarter. And you can see that reflected here in the Americas as well as Europe, Middle East, and Africa. 2025 recurring net new subscription sales was actually down 15% in the Americas and down 36% and EMEA. However, the recurring subscription run rate is when you annualize all the subscription fees for a quarter to the entire year, they were actually up 7% in the Americas, especially organic growth of 7%, 8% organic growth in Europe, Middle East, Africa, and 8% organic growth in Asia Pacific. David Perlmutter continues on, but it helps to look back so we can keep things in perspective. Retention rates can jump around a little bit in the short term, just like anything else, but are clearly quite steady as we zoom out. The subscription growth also can be lumpy in the very near term. Basically, he's saying this thing's going to hop around. It's going to do that every single quarter. Expect it, but over time, you're going to see periods of faster growth and slower growth. But I encourage you to read this whole thread. It does a very good job of describing why this is just a bump in the road for MSCI and that they have very good long-term sustainable growth ahead of them. So we'll dive into the beats and misses in MSCI versus expectations, review their earnings report, assess their outlook, and finally, provide what I believe is the appropriate buy price for this wonderful business. Is it still at a premium after earnings? Let's find out. Looking at the summary of the earnings report here, we can see that their growth is just very steady. Year to date, revenues are up 9.4%, operating income is up 11%, and more importantly, they continue to expand their margins. 52% operating margin in 6 months ended June 30th of last year versus 52.8% year to date this year. And like I said earlier, that really does reaffirm the strength of their economic moat. And MSCI themselves, long term, is actually forecasting operating margin to be in the high 50s. Other things to note here, we have the earnings per share up 16.3% for the quarter at $3.92 per share. Year to date, it's at $7.63 per share, which is up 15.8%. MSCI also continues to aggressively buy back shares. The weighted average diluted shares outstanding was 77.5 million in the second quarter 2025, down 2.2% year over year. So that 2.2% is an uptick over their 3-year CAGR of share buybacks, which is at 1.84%. So not only are they growing organically, they're rewarding shareholders as well. However, one other negative of their earnings report here is their net cash by operating activities. It came in this quarter at $336 million. And year to date, it's at $638 million. Both are down from the prior year numbers, $349 million in June of last year and $649 million year to date through June of last year. That also means their free cash flow is actually down slightly. This quarter, they had free cash flow of $302 million. That is down from last year's of $322 million. But I believe that is due to two main factors here. We can see these other adjustments is significantly lower this year than it was last year. And when you're adding that adjustment back into net income to get your operating cash. Now, the big component here is actually deferred taxes. Deferred tax is a very complex thing, but the point is it is mainly due to timing differences between what is actually taxable income versus book net income. MSCI doesn't elaborate in the earnings report at all. And also a significantly larger change here to operating assets and liabilities, meaning they're essentially beefing up their working capital. So addressing working capital needs and deferred tax situations to me is not a red flag. And on that point, you can see their full year free cash flow guidance is actually between 1.4 billion to 1.46 billion. And taking to the midpoint of 1.43 billion, that would actually be a 3% increase year over year of free cash flow. I, of course, linked the earnings report here if you wanted to take a look here at the rest of their full year guidance. The projections I have for MSCI over the next 10 years, at least for their revenue here, on a total revenue basis are at 6.94% for the bear case, up to 11.3% on the bull case. MSCI itself is projecting low double-digit revenue growth long term. So I believe I'm being fairly more conservative in my estimates than MSCI. I'm also more bullish on their index segment of the business rather than their ESG segment of the business. So I have that growing at a bit faster of a rate here on the bull than I do the ESG, even though MSCI is projecting 20% growth long term for ESG and climate. And as we see with their operating margin on the bear case, I have that at 55% by year 10, up to 60% for the bull case, which would translate into a free cash flow margin of 48.5% 5% in the bear case by year 10, up to 54.4% for the bull case. And if we look at their PEG ratio here, you can see they are a bit overvalued. And for the PEG ratio, I'm looking at their forward PE over their earnings per share growth. MSCI closed the day at $552.79. It's a PE ratio of 36.6 and a forward PE of 34.3. You can see both the PE ratio and forward PE are below their 5 and 10-year averages. Right now, with a reverse DCF, the market is pricing free cash flow growth over the next 10 years of about 9.35%. My base case DCF model has free cash flow growth at 8.8%. The bear price DCF I have for MSCI is at $418.17, $526.53 for the base case, and $730.37 for the bull. They do pay a very good and growing dividend. The trailing 12 dividend growth rate for MSCI is at 16%. So my bear case dividend discount price is at $645.60 up to $917.69 for the bull case. That's dividend growth rates on my bear case at 12%, 14% for my base case, and 16% for the bull case. Their exit multiple sits at $573.80, and that's with comps of S&P Global, Intercontinental Exchange, and CME Group. So you can see there's a little bit of downside on the bear case, but nice healthy upside on the bull case if they execute very well. That's a buy price of $612.01 without any margin of safety, and with a 10% margin of safety, my preferred margin of safety, that is a buy price of $550.81 with a forward PE of 34.2. In my view, this is a very safe and reliable business. It's growing very steadily, and it will grow very steadily into the future. So I am comfortable with a 10% margin of safety. But if you're looking for more margin of safety, have a lower risk tolerance, then a buy price at $489.61 with a 20% margin of safety and a 30.4 forward PE might be more suitable. So anything under 550 I think is a decent price, but that's with my risk tolerance. Waiting until it comes down below 500, even below 490 might be better for some. And I think anything below that would be very good value for MSCI. But regardless, I think this business will grow very well over the next 10 years. It is a cash flow machine and will provide very good value to investors in the long term.
Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.